Good evening, everyone. It's fantastic to see everyone here tonight. Welcome to our webinar on how rising insurance costs are shaping the real estate landscape. We are absolutely thrilled you could join us. I am Anchal Divedi, managing partner at Goldstone Capital Ventures. Alongside me are my fellow managing partner, Dinesh Nayak, and our guest speaker, JT Lynch. We have got an exciting session ahead, packed with insight and valuable information. So hang in there. A little bit about Goldstone Capital Ventures. We live and breathe real estate. We excel at identifying, underwriting, acquiring, and managing commercial assets with enormous value add potential. Our mission is to transform properties into vibrant communities that generate impressive financial rewards for our investors and create exceptional living spaces for our residents. But that's not all. We are also experts in developing brand new apartments and other commercial assets. To date, we have acquired over 16 real estate assets totaling more than 1,600 units in prime locations in Carolinas, North and South, Texas, Tennessee, Wisconsin, Florida, and other parts of the country. Our diverse portfolio includes value-add apartments, ground-up construction projects, student housing, assisted living facilities, short-term rentals, and much more. We are expanding into Virginia and actively exploring industrial and flex spaces due to soaring demand. Also looking for medical buildings, which is considered as very stable investment. Our upcoming projects in various asset class highlights our commitment to diversification. So without further delay, I'm going to hand things over to Dinesh. He will walk you through our current portfolio and the latest acquisitions, and also introduce our guest speaker. Dinesh, take it away.
Okay, thanks, Anchal. So, good evening, everyone. We have a really interesting topic today. Let me. Okay. Yeah, we have. I just wanted to show a few properties that we have acquired recently. This is assisted living that we acquired last year in Wisconsin. This is Eastman Quarter student housing, 252 beds in Nashville, Tennessee. There are a couple of other properties, Ivywood Apartments, 96 units in South Carolina. This is a new construction project that we just started, 184 units in North Carolina. Sweet Redemption, this is again a short-term rentals just outside Dallas, 44 units. And then another property, 98 townhomes in South Carolina. So this is another B-class property in Charleston. With that, I would go ahead and introduce our guest speaker, JT Lynch. We have been working together for a while now on different projects. So he's a commercial insurance broker with the Rami King Insurance. As a broker, he works with multiple carriers to find the best coverage at the lowest premium while meeting all the lender requirements. So they are specialized in multifamily insurance for over 35 years, and they're licensed nationwide. So take it away, JT.
Yeah. Thank you so much for having me, and happy to be here. And yeah, the intro was perfect. We're a full service agency, so I do have clients that own trucking companies, equipment, rentals, and things like, I mean, all over the place. Daycares, but 90%, maybe even 95% now of what we do is all multifamily. And I think that's important, especially in a hard market like today, is to really find your niche and really be able to hone in on what you do good and kind of stick to that area. If what is the saying? If you have many talents but you're master of none, then that doesn't really help you, right? So I think having that focus and knowing and having the relationship with all the carriers and underwriters to be able to write multifamily makes a big difference. So thanks for having me on. One of the things, challenges right now is what everybody's seeing is the high premiums and high deductibles. And I often get asked, well, why does that happen? Why now? So I did prepare a uh, very brief PowerPoint presentation, and I'd like to go over that now, if that's okay with you.
Sure.
So can you see this at all? Do I need to share my screen?
You should be able to share the screen.
Let's see.
You haven't yet.
All right, here we go. Y'all see that?
Yes.
Yeah.
Okay. So there's a couple things that happened, and it's a little bit different in every state. So Florida is a mess, but a lot of that has to do with obviously the catastrophes that come in from hurricanes, but also the legal challenges that are there. It's just a lot easier to sue insurance carriers for more of a claim than it is in other states. And so with more lawsuits, that kind of makes things a little bit trickier. So Florida is a mess in itself, but I'll get into the two biggest challenges of what's going on in the multifamily insurance market right now. Basically, kind of how did we get here, and when will it get better? And if you guys have questions along the way, feel free to stop me, and I'm happy to explain further if we need to. So the two biggest things that's going on right now is claims, the amount of claims paid out by insurance carriers, and the increased cost of construction and labor. When anomalies happen like the Texas freeze, was that a few years ago now, the properties that had damage, they actually didn't have huge claims. There's a few broken pipes here or there. So there weren't, there wasn't $1 million claims in most cases, like there would be with a hurricane or a tornado, flood, something like that. The thing is it affected the entire state of Texas. So when there's, almost every property in every city having an issue and they all make a claim at the same time, that's a crazy anomaly. But it does really hurt a lot of these insurance companies. And then the bigger thing of that is just this increased cost of construction labor from inflation. So we'll get into both of these. This was data from late last year, but it still holds true here and it applies. So basically through September 2023, there have been 24 confirmed weather climate disaster events in the U.S. with losses exceeding $1 billion. This puts the U.S. on pace to exceed any prior annual record number of billion-dollar disaster events. So the mixture of some of these catastrophic events, we're talking about hurricanes, massive freezings, things like that. But then also what's being paid out. So with the increased cost of construction, I know that you guys said that you're doing a new build, right? And I'm sure if you looked into new builds, before 2020, the prices were much different than it is now. So same thing, if you had a fire and you've got to rebuild the property, it's going to cost a lot more than it used to rebuild that building, right? And so a claim, and this is, I've seen it with actually my own clients. Unfortunately, fires happen, accidents happen. And what we've seen is in a couple of cases, a claim made for a fire in 2020 may have been $1 million payout. Same type of claim made in 2023, just last year, was a $6 million payout. I know that everybody, not everybody, most people do not like insurance companies. They feel like they're crooks, or they're not paying out as much as they should. Well, the fact of the matter is, if they have to pay out $6 million for a claim, but they're only getting maybe $50,000 from you in insurance premium, then it's really hard for them to catch up. And they've got to have a pool of money to be able to pull from to pay out future claims. And with one claim being a $6 million fire, that makes a big difference. So what they've had to do is update the replacement cost value. So the replacement costs were too low, basically, in order to cover these claims. So they've kind of had to right size the amount of replacement costs for all these properties. And that's what we've been going through the past few years. And so the way that they make and bring more money into the pool to be able to pay out future claims is there's only a few ways to do it. They've got to increase replacement cost values, like I spoke about a second ago. They've got to increase premiums, increase deductibles as well. We've seen a lot of them decrease their appetite. So where they used to insure almost any multifamily building, now they'll say, I'm not going to insure in Houston. I'll only insure 1990 or newer, and nothing over 3 stories. So that they start limiting the amount of things that they'll actually insure, and that helps them kind of stave off any unforeseen claims, and they think that it helps them be less risky, I guess. And then also the other thing is they'll decline to write it. We've seen plenty of carriers just pull out of states altogether. They say this isn't working for us. We've got to regroup, and it's possible that they'll come back. But Houston and Florida right now, we're seeing that a ton. Just carriers refusing to write altogether. And what that does is it only leaves, maybe 6 carriers that are left. And if a big catastrophic event comes through, well, now they're holding the burden for all those future claims that may come in. And so they know that it's when they ask for higher premiums, higher deductibles. I don't think of it as being greedy or anything like that. I think they're trying to protect themselves, knowing how much risk they have, especially since they're the only ones left taking on all the risk. The good news is most properties are now at the correct replacement cost. During most of your renewals, you saw maybe a slight rate increase, but then the premiums increased maybe 20% or more. A lot of that was because there's just a slight rate increase, but then they had to increase the replacement cost values, and all those added together brought to a big premium increases. But I think now that those replacement costs are kind of right sized, that things are going to start to level off here. We've seen many carriers begin to announce more attractive loss ratios in the past several years. And then a number of property carriers already have started to increase capacity and start to come back into places like Texas and Florida, where they had left. A lot of these carriers that are coming back, their appetite's very small. So like I mentioned, they'll only do Dallas, 100 units and up, with 1990 or newer, right? They won't write anything else. But the good thing is that they're coming back, and that really helps open up the market and helps give us as brokers more options. The more options, the better. It helps them be competitive, and it's really hard to do our jobs correctly when we go out and shop and there's just no options available. So they will start to expand their appetite as they get more comfortable, but the good news is on the horizon for sure. So what can I do to make sure I have the best option? I would definitely say the first thing, location's everything. Know your market. I've talked to newer investors that say, oh, I want to get into multifamily in Florida. I'm underwriting $500 a door. What do you think about that? And I tell them, you're crazy. I would say at least $1,500 a door. And that doesn't mean that you don't buy in Florida. Doesn't mean Florida is a bad place to be, but you got to know what you're getting into, right? If you're thinking it's $500 a door, well, that's going to be your first mistake. Know what kind of issues could arise in the state you're looking at. Know about the crime that may be there as well. Different carriers will use different crime statistics, and there's different avenues that they find that out. The easiest way that I can think of, and Dinesh, I'm sure you've done this before, is just Google the address. You Google the address, and the first couple pages on there, you'll see what kind of crime is there. If there was a double homicide across the street a couple weeks ago, that tells you exactly what you need to know about this area. That doesn't mean that you're not going to buy it. That just means that you need to know what you're getting into. Your general liability is probably going to be a little bit higher in premium. You may have some You may have some exclusions that you would rather not have, like a weapons exclusion, firearms, animals exclusions, assault and battery, things like that. So if you get into a property like that, you know, make it safer, make the better lighting in the parking lot. Get if you don't have it fenced in, get it fenced in, get a gate, have a security patrol officer come by. I had an asset manager tell me the other day that they have an office at their property, and they invite police officers to work out of there anytime that they want to. The only stipulation is you have to park your patrol car up front so everybody sees it when they drive in. And they do. They offer free coffee to them, and if you need a place to sit down and do some paperwork, come here to do it. They also offer police officers free rent if they stay there. Only stipulation is you got to park your patrol car up front. So those are little things that you can do to, make the property safer for your tenants. And underwriters, they pay attention to that type of stuff. They are watching. They want to make sure that you're not a slumlord and not just doing anything for your properties, but you're actually making the property safer for your tenants and for your future investment. Underwrite appropriately. Be prepared for higher deductibles. Be prepared to be able to pay for a 20% increase in insurance if it happens. Just underwrite it correctly. If it doesn't make sense, be conservative in your underwriting. And even if you're very conservative and it doesn't make sense, then maybe that's not something that you want to get into at this present time. And the other thing is, make sure that your insurance broker is a specialist in multifamily insurance. A few years ago, before this hard market started, I would have all kinds of clients say, "Oh, my brother-in-law, he owns an agency. He's going to help me with this." And in some cases, maybe they could, but nowadays with this hard market, you really have to have a specialist that works in this field most of the time, that knows and has a relationship with these underwriters and carriers to be able to find the best fit for you. Because right now in this hard market, it's very hard to find. And if that's not something you're used to, then you're going to be behind the 8 ball right from the get-go. So yes, Ramey King, I think mentioned before, we specialize in multifamily for over 35 years. We're licensed nationwide, and we're happy to help with anybody in their upcoming LOI or renewal. One thing that I do that's really unique to help with your underwriting, if there's a property that pencils out on your end and you're looking to submit an LOI, you can email me the rent roll, the T12, and the offering memorandum, and I'll send you a free insurance estimate to help with your underwriting. And I base that estimate off of like-kind properties that we've already quoted in the area. And so you can know kind of real hand, despite relying on the T12 and the offering memorandum, what your insurance costs are going to look like, so you can be better prepared for that. So I'm happy to help with anybody here on this presentation today with that. So please reach out to me if you need any help with anything.
Yeah, if somebody wants to put their questions in the Q&A box, feel free to do it. Jerry, can you explain a little bit about the claim processing? How does it take longer now because of all the complications and
No, I mean, the claims process is I kind of chuckle a little bit when somebody says, "Oh, I had a terrible claims experience with that company. I'll never use them again." I've never really heard of anybody ever having a great claims experience, partly because you've had a problem, and no one's happy when a problem happens. No one wants to have something that they have to fix all of a sudden. So, I mean, no claims experience is going to be very very lovely, I don't think. But it does take a while. A lot of times there's third party companies that will come out and assess the damage as well. So there's a lot of back and forth that goes into it. Unfortunately, I don't really get involved with much of the claims process. My job really is to diagnose, first of all, should we make a claim? Are we doing the right steps to prevent this claim from getting even worse. Your deductible is this. Is it even worth making the claim? Okay, let's go ahead and make the claim. I'll get you in touch with the claims adjuster and kind of hold hands, making sure that that process is as smooth as possible. But as far as the actual process, I don't do much of, but I know that it does take a while. But you know, it really depends on the nature of the claim, I think, and what occurred. So good question though.
Yeah. Have you done any triple N industrial or any other commercial asset types?
Yeah, absolutely. HOAs are big right now. Hotels, motels. I mean, we can do RV parks. We can do pretty much anything. The RV parks and the self-storage, that's actually pretty easy to insure because there's not much risk there. With the RV parks, you know, the biggest part of the premium is probably your general liability, but there's usually not structures there that you have to insure. So there's not big buildings.
Yeah.
So that makes it a little bit easier. So yeah, the harder things are these bigger multifamily properties, especially in challenging states like Texas and Florida for sure. But yeah, we can insure it all.
What about the warehouses and the retail centers?
Yeah, absolutely.
Have done
The
those too.
retail centers are similar to multifamily as far as how we look at it. One of the challenges is what type of businesses are at the retail centers. Usually it's going to be a restaurant or two. There'll be like a vape shop, a salon, and maybe a comic book store or something like that. Usually there's not too much risk, but occasionally you come across a gun store or a bar, things that have lots of liability. So that can be a little bit challenging depending on what type of tenants are there and what part of town it's in. But other than that, it's actually a little bit easier than multifamily just because it's usually not as big of an area. What's interesting is when you get multifamily with retail on the bottom floor, and then that adds another layer to the insurance there too.
Wow. Yeah.
So, JD, what are the modifications that we can do to the property to get best premium? You know, for example, you know, having a security camera across the perimeter of the property or also inside the units help reduce cost. You covered some of them, but are there any low-hanging fruits that we can address fairly quickly and that will affect the premium?
Yeah, that's a great question, one that I get all the time. There's not one particular item that's going to say if you do this you get 10% off, right? But I would say the underwriters, they're human. They have first impressions as well. They want to see what type of owner you are, right? And so the first thing I would say is make sure your website's updated. If the property has new paint and it looks so much better than it used to, but you don't have those pictures up on your website right now, well, how's the underwriter supposed to know that, right? So that's the first thing I would do is make sure your property looks appealing. Make sure it looks like somewhere that you would want to live, and make sure that your website's updated because that's one of the first places the underwriter is going to go to. Make them have a good feeling when they go to your website, like this is a place that I would live and I would definitely insure this, right? So I think some of those things are kind of obvious, but a lot of times you don't see it happen for whatever reason. The other things are once a carrier you bind coverage with them, usually a couple months later, they'll come out and do an assessment of the property. And then they're just looking at things like cracks in sidewalks. Is this tree limb really close to one of the units? Then it could fall during a storm and cause damage. Are the dumpsters too close to the building? So if there was arson in a dumpster, which this happens a lot for some reason, but if someone sets fire to the dumpster, then could the fire travel to the building quickly? If the answer is yes, let's move the dumpster farther out from the building. So they'll have a list of items, we call them rec letters, but recommendations for the property that they want to see completed to make it safer. A lot of owners hate it because they don't want someone coming in there telling them what to do with your property. And oh my gosh, if I do this, this is going to cost me this much money. But really, it's to prevent future claims from occurring. The biggest killer, if you're already paying a high premium and man, your renewal came back and it's 10% higher, what are we going to do? That's bad enough. But if you had a big claim, like a $1 million fire claim, then there's really not many options. There's a couple carriers that'll take you with a claim like that, and you're going to be paying maybe $2,000 a door with really high deductibles. So that's the real killer. So it's limiting the claims, the potential future claims, as best as possible. That I think is paramount right now, until things start to get a little bit better. You just can't afford to have these big claims. So do all those recommendations that the carrier is asking you to. Be proactive. And it all comes down to the property management company too. Make sure your property management company is doing their job, is paying attention. If there was a complaint from a tenant that, I don't know, a stray dog's been hanging around the properties, well, make sure to address that right away. If that stray dog they're complaining about, you didn't do anything about it, and then they bit a child, well, now there's a future lawsuit, coming your way, when you could have just handled it, as soon as somebody told you about it. So I think being as proactive as possible is really the best way to do this right now. And then just bite the bullet and wait for the things to start to calm down is the best you can do, really.
Okay. But also, can the policies be customized based on specific needs? If we have like a multifamily portfolio, located in the same state but different cities, can we have like a one policy for the entire portfolio?
You can. Usually for that to make a big difference, with lower premiums, everybody wants to say, well, I have this many doors, I'm going to group them together and now have lower premiums. Right now, the programs that I've seen are really big property management companies. We're talking 40,000 doors that they manage. That amount of doors is what's really going to drive lower premiums and lower deductibles. And unfortunately, most normal owners, like me and you, we just don't have that many doors. And even then, there's less of those programs around anymore, and some of them aren't competitive. So I've helped plenty of people that they're with name big property management companies insurance, and it's still not that great. Sometimes doing it a la carte is a better way. And part of it is, yes, they're like-kind properties in the area, but one of the properties may have had a big fire last year. Another property is actually 60s build with bad wiring. Another one is in a really bad part of town. And so to make that all work, well, no, they're not actually at all that like-kind, right? Some of these have problems that we don't want to take on, but if we don't take on all of them, then we don't have enough to even affect the premium. So we're seeing less and less of those programs, but it's always something worth to look into, and definitely ask your broker about every option, because it could be a viable option for sure.
Okay. Thank you.
Yeah, there are some carriers, they do not cover some of these older properties, right?
Yeah.
Do you recommend or do you suggest we narrow our buy box based on that?
Yeah, 60s and 70s, that's when all the bad wiring was, when the bad breaker boxes. So yeah, there are a lot that they just, no, we're doing 1980s and newer. And so I've talked to a lot of owners that said, you know what, yeah, we're staying away from that older stuff now, and we're just looking at 1980 and newer. I think that over time that they will start to broaden their appetite and start to look at those asset classes again. But yeah, it seems like there's more carriers willing to write the newer items. And I say newer, 1980 was 44 years ago. That didn't seem that long ago, but yeah, they just don't want the super old stuff with the bad wiring and the bad breaker boxes. You're right about that, Dinesh.
What do you see in future? Do you think the prices will stay stagnant or might even go down, or will they, follow the, 2%, 3% increases?
Yeah, I think that a lot depends on this hurricane season this year. If it's fairly mild and there aren't a ton of claims, then I think we'll see a lot more carriers start to come back. They'll start to broaden their appetite. And I think that if that happens, that it'll kind of stay level this year. And then into 2025, we can start to see things start to drop and be normal again. This is all cyclical. I know that everybody's going crazy right now. The sky is falling, and I understand that the premiums are real high. I'm an investor myself. One of the properties that I insure had a capital call the other day. It's in my best interest to get the lowest premium possible so that I can get a return, right? But there's just not a better option out there. So I'm feeling it just like everybody else.
Right.
But I do think that if we can have a mild hurricane season and no weird Texas freezes, things like that, then yeah, things will start to normalize. But again, this is all cyclical. There's been hard markets before, then they turn to soft, then they go to hard. So historically, yes, it will come back, and it always has. So
Okay. Yeah, again, among the audience, if you have any questions, just raise your hand or you can enter them in the Q&A box. So, yeah, we just wanted to keep our investors aware of the rising insurance costs and how we underwrite and the impact of the insurance cost on the evaluation of the properties as well. So
yeah. One challenge we've been seeing lately is the smaller properties like 30 units and less. It's harder for us to find carriers that will meet Fannie and Freddie requirements for those properties. So a carrier, they don't necessarily want to put all their eggs in one basket, right? So if they're writing properties in Dallas, they don't want one huge storm to come through and have a huge one claim on all their properties, right? So if I'm going to insure a property and not run out of capacity in Dallas, I'm going to insure the 150 unit, not the 30 unit, right? I'm going to insure the one that has more premium coming in. And I'm not going to waste my capacity on these 30 units. And so a lot of them, they just won't look at those smaller ones right now. And so we can insure it, we can find coverage. But as far as getting the Freddie and Fannie requirements that are necessary, that's been a little challenging as well. So if you're somebody that's afraid of starting out with a higher number of units to purchase, I would say it might be easier. And you guys know this, it's just about scalability and then the ability to raise a little bit more money. But really with the bigger properties, then you can get a property management company in there. Sometimes with these 30 units and less, sounds like a great deal, but it may be more challenging than you just scaling up a little bit more. So
okay, cool. Yeah, have you seen the lender requirements changing drastically over the last couple of years?
I have seen them. They are looking for higher building values, for higher, replacement costs. So if there were a fire, they want to make sure that they're covered. So I've seen them increase that amount. I have seen them be more lenient on deductibles though. So 3 years ago, the wind hail deductible 2% was about standard across the board, and now 3 and 4%. We're seeing that, and it used to that lenders wouldn't accept that at all, and you'd have to get a deductible buy down. But now I think they understand that now this is just where the market is. So we've been seeing them waive a lot of those type of requirements. So yes and no. I think they're being a little strict when it comes to replacement cost values, but then they're backing off on some other things. the good news is a lot of these lenders and the lender analysts that we work with, I see them all the time. I mean, we close on probably 20 a month, right? And so we're seeing the same type of people, and so we kind of build a relationship with them. And a lot of times it's easy for us to go and on your behalf kind of negotiate with them. We've got replacement cost estimator tools that can say, you know, I know you want $150 a square foot. This tool that we have here says that $120 will suffice. And a lot of times, if you can just bring them evidence, they'll say, okay, yeah, we'll waive that. We'll go to from 150 to 120. So we're always looking for ways to negotiate with them and work with them. But yeah, ultimately it's whatever the lender says, and you guys know this. I mean, if they want a 2% wind hail deductible and they're not going to budge, that there's not much we can do. So we'll do everything we can, but they're the boss at the end of the day.
Awesome.
Yeah.
Good. I think we met you in Best Ever in April.
Yeah.
Is that right? Okay. Right. Good. And any other? I know you go to a lot of conferences. Any immediate conferences you're going to?
The next one, I'm actually going to Cabo next week, but
Wow.
Jeff King and my associate Aaron will be at Quest Expo. And let me see where this is. Oh, it's at the Irving Convention Center. This is our first time to go to Quest Expo. I don't know much about them at all, but that's our next event. So, you know, and the one thing is Best Ever's great. We've been to Jake and Gino, Sumrock, all of them, you know, are great, but especially the things that are in Dallas around our hometown, we try to get to all of those. It's just so much easier to get to. Traveling to Salt Lake or Orlando, it's great, but it's expensive. And it's just a hard thing to do. So sometimes you can, you know, you can just be doing so many events that you're kind of out, you're losing your steam. You can't do anymore. So sometimes we feel that. It's this spring we had a lot of events that we were going to, and it's kind of slowed down, but they'll start picking up here in the fall, and
Right.
we'll start to we try to go to as many as we can, and sometimes it's tough to go to all of them.
Yeah, I know. It's and you know, it carries forward your workload that much. So
Yeah, right.
all right. Yeah, thank you so much for your time. I don't see any questions from the audience. So
Okay. And I dropped my contact information in the chat, so if anybody needs help, feel free to reach out to me. And happy to help. Happy to be here. Thank you.
Yeah, thank you so much for your time.
Great session, JD. Yeah, thank you so much for your time and fantastic session. I think everyone will be benefited by it. Yeah.
Okay, wonderful. Thank you guys.
Have a good one.
All right, you too.
Bye-bye.
Bye.